So, you've heard the stories, right? Traders making a killing in crypto, not just when the price is soaring, but when it's absolutely cratering. You've seen those charts with red candles falling off a cliff, and yet somewhere out there, someone is celebrating a huge win. It sounds complicated. It sounds risky. It sounds like a club reserved for elite professional traders with a dozen monitors and years of experience. You've wondered how they do it, but the complexity and the fear of losing a ton of money have kept you on the sidelines. What if I told you it's not nearly as complicated as it looks? What if the ability to profit from a falling market is a skill you can learn right here, right now? In this video, I'm going to take you from a complete beginner, someone who's maybe only ever clicked buy on a spot exchange, to placing your very first futures trade. We're going to pull back the curtain on this entire world. We'll break down everything from leverage to shorting in plain, simple English, and I'll walk you through every single click. No confusing jargon left behind. By the end of this video, you won't just understand how futures trading works, you'll have a safe, clear, and repeatable strategy to get started. Forget the idea that this is only for the pros. Today you join the club. All right, let's kick things off with the absolute basics. What on earth is a crypto futures contract? The easiest way to get it is to compare it to what you probably already know: spot trading. When you go on an exchange like Coinbase or Kraken and buy Bitcoin, you're spot trading. You pay your money, say $1,000, and you get an actual chunk of Bitcoin in return. You own that Bitcoin, it sits in your wallet, and you can withdraw it, send it to a friend, or use it to buy something. You're trading dollars for the asset itself. Simple. Futures trading is a whole different ballgame. When you trade a futures contract, you are not buying or selling the actual crypto. You never take ownership of a single Bitcoin or Ethereum. Instead, you're making a contract, an agreement to buy or sell a crypto at a specific price at some point in the future. In short, you're making a bet on where the price is headed. Think of it like this: you and a friend are watching a football game. You're convinced Team A will win. Your friend is sure it'll be Team B. You make a simple $100 bet on the outcome. You don't own the teams or the stadium, you're just speculating on the result. When the game ends, one of you pays the other. That's the core of futures trading. You're trading the price movement, not the asset itself. The most popular type you'll see are called perpetual futures. Unlike old school futures with a fixed expiration date, these never expire. You can hold your position for 10 seconds or 10 months as long as you have the funds to back it up. That flexibility is exactly why they're the favorite for most crypto traders. So that's the what. Now, for the much more important question, why? Why bother with a contract about crypto instead of just buying the real thing? There are two massive reasons, and they're what make futures trading so powerful. The first and the most famous one is the ability to profit from a falling market. This is called shorting. With spot trading, you only make money one way: the price goes up. You buy low and sell high. That's the only move you have. But what happens when the market is trending down for months or even years? In a bear market, spot traders are either losing money or just sitting on their hands. Futures traders, however, can make money in both directions. If you believe the price of Bitcoin is about to drop, you can open a short position. If you're right and the price falls, you make a profit. This changes everything. It means there are opportunities whether the market is soaring or crashing. You're no longer a one-trick pony. We'll get into exactly how shorting works in a minute, but just know that it unlocks the other half of the market. The second huge reason is leverage. Leverage is a tool that lets you control a large position with a small amount of your own money. For example, with 10x leverage, you could use just $100 of your capital to open a trade worth $1,000. This means your profits are calculated based on the full $1,000 position, not just your initial $100. It magnifies your gains. Now, this is the part where I need you to pay close attention. Leverage is a massive double-edged sword. Just as it magnifies your gains, it magnifies your losses at the exact same rate. Using high leverage is the single fastest way for a new trader to lose everything. We're going to have a serious talk about using leverage responsibly later. For us as beginners, we'll be using very, very low leverage. But having access to it, even in a small, controlled way, is a key feature of futures. So to recap, futures let you bet on price without owning the asset. They let you make money when the price goes down, and they give you access to leverage. Now let's get into the core ideas you must understand before you even think about clicking that trade button. This is the most important section of the entire video. If you can really wrap your head around these four concepts, you'll be ahead of 90% of people who try futures trading and fail. We're going to break them down with simple analogies. 1. Going long, the bullish bet. Going long is the easy one because it feels familiar. When you go long, you're betting the price is going to go up. You're bullish. You enter a long position, and if the price rises, you're in profit. If the price falls, you're at a loss. It's basically the same idea as buying Bitcoin on spot and hoping the price goes up. 2. Going short, the bearish bet. Now, for the magic trick, how do you make money when the price goes down? Here's the classic analogy that makes it all click. Imagine your friend owns a rare collector's item, let's say a signed basketball with a current market price of $1,000. You've got a gut feeling that a bunch of similar items are about to hit the market and the price of this basketball is going to tank. So you ask your friend, "Hey, can I borrow your basketball for a week? I swear I'll give it back to you in perfect condition." Your friend agrees. The second you have the basketball, you immediately sell it on the open market for $1,000. Now you have $1,000 cash, but you also have a debt. You owe your friend one basketball. A few days later, just like you predicted, the price plummets. You can now buy an identical signed basketball for just $400. So you go to the market, buy one for $400, and return it to your friend, settling your debt. What just happened? You sold high at $1,000, you bought low at $400, you returned the borrowed item, and you're left with a $600 profit. That is exactly what short selling is. When you open a short on an exchange, you're essentially borrowing Bitcoin from the exchange, selling it instantly at the current price, and waiting for the price to fall. When you're ready, you buy back the Bitcoin at the new, lower price to return it, and you pocket the difference. Of course, this all happens instantly on the back end. For you, it's just a click of the sell short button. But what if you were wrong? What if, after you sold that basketball for $1,000, the price skyrocketed to $1,500? You still owe your friend a basketball. You'd be forced to go buy one for $1,500, using your initial $1,000 and pulling another $500 out of your own pocket. You've just lost $500. That's the risk of shorting. If you bet on the price going down and it goes up instead, you lose money. 3. Leverage, the magnifying glass. We've touched on leverage, but let's look at the mechanics. Think of it as a tool that magnifies your trading power, like a loan from the exchange. The money you put up yourself is called margin. Let's say you have $100 in your futures account. With 1x leverage, you're just using your own money. A 10% price increase turns your $100 position into $110. You made $10, a 10% gain. Now let's use 10x leverage. You still put up your $100 as margin, but you now control a $1,000 position. 100x $10. If the price goes up by that same 10%, your profit is based on the full $1,000. A 10% gain on $1,000 is $100. You just made a $100 profit with only $100 of your own money. 100% return. You can see the appeal. But, and this is the scary part, what if the price went down by 10%? Your loss is also calculated on the full $1,000. A 10% loss on $1,000 is a $100 loss. Since you only put up $100 of your own money, that loss wipes out your entire initial capital. Your position is closed, your money is gone. This brings us to the most dangerous word in futures trading. 4. Liquidation. The game over screen. Liquidation is when the exchange forcibly closes your leverage trade because your losses are about to exceed the money you put in, your margin. It's the system's way of protecting itself from losing the money it lent you. When your losses eat through your entire margin, you get liquidated. Your initial capital for that trade is gone forever. Let's go back to our 10x leverage example. You used $100 to open a $1,000 long position. As we saw, a 10% price move against you creates a $100 loss, which is your entire margin. At that point, the system automatically closes your trade. That 10% drop is your liquidation price. The higher the leverage, the less room you have for the price to move against you before you're wiped out. At 10x leverage, a not 10% move against you gets you liquidated. At 20x leverage, a now 5% move against you gets you liquidated. At 50x leverage, a 2% move against you gets you liquidated. At 100x leverage, a tiny 1% move against you will wipe you out. In a market as wild as crypto, where prices can swing 5% in minutes, using high leverage is like playing financial Russian roulette with a fully loaded chamber. This is why our beginner strategy will stick to extremely low leverage, between 2x and 5x max. This gives your trade breathing room and keeps your liquidation price far away. Your number one job as a new trader is not to get rich. It's to protect your capital and stay in the game. If you're finding this breakdown helpful and things are starting to click, do me a quick favor and hit that like button below. It really helps the channel and lets me know I'm explaining this clearly. All right, enough theory. Let's get practical. To trade futures, you need an account on a crypto exchange that offers them. Some of the biggest names for this are Binance, Bybit, and Kraken. The good news is that the interface and principles are nearly identical across all major platforms. Step 1. Choose and fund your exchange. Account first. Open an account on a reputable exchange that supports futures trading in your region. Once you're set up and verified, you need to get money into it. Most futures are traded against a stable coin like USDT, so you'll usually need to deposit or buy some USDT in your main spot wallet. Step 2, transferring funds to your futures wallet. This is a super common stumbling block for beginners. Exchanges keep your funds in different buckets. You'll have a spot wallet for buying and holding, and a separate futures wallet, sometimes called a derivatives wallet. Just because your money is on the exchange doesn't mean it's ready for futures trading. You have to manually move it internally. Look for a transfer button in your wallet. You'll then select moving funds from spot to futures, pick the coin, USDT, enter the amount, and confirm. It's instant and free. Your funds will then appear in your futures account, ready to be used as margin. Step 3, navigating the futures trading interface. Opening the futures screen for the first time is a lot. Charts, numbers, buttons everywhere. Don't panic. We're only going to focus on the absolute essentials you need to place your first trade. Let's break down the key areas. The trading pair, top left, you'll see something like BTC USDT. This is where you pick what you want to trade. You can click it to find others like ETH USDT. For your first trade, just stick with Bitcoin, BTC USDT. It's generally less wild than smaller altcoins. Margin mode, cross versus isolated. This is a critical risk setting. Isolated margin. This is what we will always use as beginners. In isolated mode, you assign a specific chunk of money to a single trade. If that trade goes wrong and gets liquidated, you only lose the money assigned to that one trade. The rest of your futures wallet is safe. Cross margin. In cross mode, your entire futures wallet balance is used as a safety net for all your open trades. If one position starts failing, the system pulls from your available cash to keep it alive. This sounds good, but it means one catastrophic trade can wipe out your entire account. As a beginner, always choose isolated margin. It quarantines your risk leverage setting. Right next to margin mode, you'll see the leverage slider, often defaulting to something crazy like 20x. Click on it. We're going to dial this way down to a responsible level like 3x or 5x. The order entry box. This is your control panel. It's where you'll set up your trade, with tabs for buy long and sell short and different order types. Let's walk through it click by click. We'll use a hypothetical scenario with simple numbers. Assume we have $1,000 in our futures wallet and we're going to follow our strict risk rules. Executing a long trade, betting the price will go up. Let's say Bitcoin is at $50,000 and you think it's heading higher. Set your parameters, check that BTC USDT perpetual is selected, click the margin mode and select isolated. Click the leverage setting and adjust it down to 3x. Choose your order type. You'll see options like limit and market. A market order gets you into the trade immediately at the current price. It's fast and simple. A limit order lets you set a specific price you want to enter at. If BTC is at $50,000, but you only want to buy, if it dips to $49,800, you set a limit order there. It only fills if the price hits your target. For your first trade, a market order is the simplest way to get in on the action. Determine your position size. Now, decide how much of your own money you want to risk on this trade. Let's use $50 of our capital as margin. Under the Buy Long tab, find the cost or margin field and type in 50 USDT. Because you set 3x leverage, the exchange will show you that your actual position size is about 150 USDT, your $50 margin x3. Place the order, double check everything, isolated 3x leverage, market order. Now click the green Buy Long button and confirm. Monitor your position, you're live. At the bottom of the screen, in the Positions tab, you'll see your open trade. It shows your entry price, the current price, your profit or loss, P&L, and most importantly, your liquidation price. With 3x leverage, this price should be far away from your entry, giving you a wide safety net. Executing a short trade, betting the price will go down. The process is almost identical. Let's say Bitcoin is at $52,000 and you think it's about to drop. Set your parameters. Again, confirm you're on isolated margin and 3x leverage. Choose order type and size. Select market order. This time, click the Sell Short tab. In the cost or margin field, enter 50 USDT. Your total position size will again be 150 USDT. Place the order. Click the red sell short button and confirm. Monitor your position. Your short position is now open. You're now in a trade where you make money if Bitcoin's price goes down. You can see all the details, including your new liquidation price, in the Positions tab. Section 5. The most important step, risk management. Placing the trade is the easy part. Seriously, managing your risk is what separates traders who stick around from the ones who blow up their accounts in a week. This is a marathon, not a sprint. Your goal is survival. Here are the non-negotiable rules. 1. Use stop loss and take profit orders. A stop loss, SL, is an automatic exit door you set in advance to close your trade at a specific price and prevent further losses. It's your emergency brake. A take profit, TP, is the opposite. It closes your trade when you hit a profit target, locking in your winnings. You must use a stop loss on every single trade. After you open a trade, you'll see an option to add TPSL. For a long position, your stop loss goes below your entry. If you entered at $50,000, you might set an SL at $49,500. This means you automatically get out with a small planned loss, long before you get anywhere close to being liquidated. Your take profit would go above your entry, maybe at $51,000. For a short position, the logic is flipped. Your stop loss goes above your entry. If you shorted at $52,000, your SL might be at $52,500. Your take profit would be set below your entry, say at $51,000. Knowing exactly where to place your SLTP is a skill that takes time, but for now, the most important thing is simply to have one. A rule as simple as, I will always set a stop loss that limits my loss to 1% of my total trading account, is incredibly powerful. 2. The golden rule of leverage. Stay low. I cannot repeat this enough. As a beginner, you have no business using more than 5x leverage, period. Starting with 2x or 3x is even smarter. Forget the Lambo stories about 100x leverage. That is pure gambling, not trading. Low leverage keeps your liquidation price far away, reduces your stress, and lets you learn without the constant fear of getting wiped out by one bad move. 3. Position sizing, risk a tiny percentage. Never go all in on one trade. A professional rule is to never risk more than 1 to 2% of your entire portfolio on a single trade. If you have a $1,000 futures account, that means your stop loss should be set so that if it gets hit, you lose no more than $10, $20. This guarantees that even a string of losses won't knock you out of the game. It ensures your survival. All right, let's wrap this up with a quick recap. We've covered the huge difference between spot and futures trading. You now know that futures let you trade price movement without owning the asset. You understand the two superpowers this gives you, the ability to short a falling market and the ability to use leverage. More importantly, you understand the immense danger of that leverage and the game over concept of liquidation. We walked through setting up your account, finding your way around the trading screen, and placing both a long and a short trade step by step. And finally, we set the ironclad rules of risk management. Always use a stop loss, use painfully low leverage, and only risk a tiny fraction of your capital on each trade. You now have the complete foundational knowledge to start your futures trading journey safely and intelligently. The key now is practice. Most exchanges offer a demo or testnet account where you can trade with fake money. I highly recommend you start there until you're comfortable. Remember, the goal isn't to get rich overnight. The goal is to develop a skill, manage your risk, and stay in the game for the long haul. If this guide was helpful and you want to see more deep dives into specific trading strategies and chart analysis, make sure you subscribe and turn on notifications so you don't miss the next video. And now I want to hear from you. Leave a comment below with the number one thing you learned from this video or any questions you still have. I'll do my best to answer every single one. Thanks for watching, and I'll see you in the next one.